Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Good Tuesday morning. Our top stories today: investors digesting plenty of news out of China this morning. Shein reporting ultra-long special government bond sales could raise almost $850 billion here in the latest efforts, of course, to boost the economy. Now, Beijing also set to begin enforcing a tax on overseas investment gains by the ultra-rich, underscoring the urgency of expanding revenue sources. Plus, a Bloomberg scoop, the U.S. weighing capping sales of Nvidia and AMD chip sales to some countries, limiting its rivals' capabilities when it comes to AI.
Yep, that Bloomberg scoop that Dave just mentioned there might actually be something that might impact how equity markets go here today, because Nvidia, before that news, actually reached a record high. Right, so there was all this renewed optimism around the stock once again, but this certainly is something that we'll watch very closely here with the U.S. weighing, capping Nvidia and AMD AI chip sales to certain countries here. We're already seeing when it comes to NASDAQ futures reacting a little bit here today. We're flat when it comes to S&P futures, but yeah, we also saw the S&P hit another record, 46, I believe, overnight. That should have been a good tailwind for equity markets, and we're still seeing that. For the most part, Nikkei 225 coming back from that holiday, and we're seeing a bit of a catch-up there of more than 1%. But really, it's been those comments that we saw from the Fed officials like Chris Waller saying, Fed's should cut with caution at a deliberate pace. Kashkari echoing that. Further modest reductions will be appropriate in the next few quarters or so. That basically sent dollar-yen higher there. We're now approaching 150 levels, which we haven't really seen since August. So the dollar is catching a bid. We're at the highest in 2 months of the Bloomberg Dollar Index as well. That's what's helping the equity market in Tokyo, too. Watching very much these chip stocks as well in Taipei. We'll see how that fares here. But so far, the TAIEX is still seeing some upside of 0.6%. And, of course, Treasury markets coming back from that U.S. holiday, or cash trading was not open. But, yeah, we're seeing yields slightly lower on your U.S. 10-year yield, but still hovering that 4.08 level this morning. Oil's one to watch. So we saw a big drop overnight, about 2% or so. We're extending that here this morning with Brent. News from the Washington Post that Israel may not want to target Iranian crude or nuclear facilities. That certainly sent a bit of a relief, I guess, when it comes to the supply concerns out there. You add that to the China exports and what we saw in the trade data that was actually weak. That's why we're seeing a bit of negativity when it comes to oil this morning. Flip the boards. It's all about dollar-yen, right? So you talk about the last 30 days or so and this upward, basically ascent of the dollar over the yen. It makes you wonder, how much more can we see? Can we actually see a floor for the currency here? Because it doesn't seem, Fed fund futures are pricing in less than, 25 basis points cuts the next 2 meetings. Can it actually get more hawkish than that is one thing that people are asking very closely. And there you go. We're getting very close to that 150 level here. Positioning is long yen too, but less conviction compared to what we saw back in July. So there you go. You take a look at what I see, China futures, and this is what we saw. So yesterday it took a while, right, to really digest all that news from the Ministry of Finance. But finally, towards the end of the session, we saw basically a resurgence, the best gain in a week yesterday. It looks like futures are slightly in the negative territory here today. And watching very closely. There's some positive news. Shein talking about raising some 6 trillion yuan from ultra-long special government bonds over 3 years. But then again, bad data to deal with too, Dave.
Yeah. The immediate impact really is, this market is running into a series of bad numbers coming through in the form of trade, credit numbers coming through. Where we did see the positivity show up was really in the bond markets, right? So CGB yields, I think we're down again on the 30-year yield. LGFVs, it's really one corner of the onshore bond market that's really seeing the tailwinds coming through out of the Ministry of Finance briefing. That's number two. Sectors to watch. Yvonne talked about oil. We'll look at what some of these energy plays look like. Crypto-related stocks, of course, on the back of that big move up, 5% in Bitcoin. Plus, staying commodities, right? So you have aluminum and also alumina, which is the ore, of course, that goes into the former. Record rally there so far. You have tight supply. More on that in a moment. A couple of briefings to tell you about. You have the space agency briefing taking place top of the next hour. And at some point, the back half of this hour, a couple of minutes after the market open, will be that weekly press briefing out of John Lee and John Lee's office. That's a day ahead of the policy address from the Hong Kong chief executive that takes place around this time tomorrow. But yep, back to the China story and back to the bond markets and this report out of Shein.
Yeah, interesting one. How they're going to raise $846 billion from ultra-long special government bonds over the next 3 years as part of its efforts to boost the sputtering economy. Let's bring in our China correspondent, Min Long, what we know more of this story.
Yeah, there has been so much speculation about the exact size of that fiscal stimulus, right? The MOF briefing on Saturday didn't give us a headline number, and now Tyson is saying that it could be 6 trillion yuan in ultra-long special sovereign bonds that is rolled out over 3 years. Now, markets was expecting something to the tune of 2 trillion yuan a year. So this is pretty much in line with market expectation, and the fact that it is a multi-year long stimulus plan, I believe that will bring some confidence to investors. Now, Tyson is saying that a part of this funding is going to tackle local government debt. And we know the Ministry of Finance had said they're going to allow this one-off increase in local debt quota by a relatively large amount to swap out tens of trillions of yuan in hidden debt. And this will free up the pressure from local governments to pay back those debt and to actually focus on expanding resources to revive the economy and to pay back all of those delayed payments, right, to contractors, to direct and indirect employees. That is something to the tune of some 10% of the GDP. So if that happens, that would essentially be a form of cash transfer, if you will, a sort of consumption stimulus for the people.
Yeah, it unlocks fiscal space. The bad data that we got yesterday, so credit numbers and trade, what are the takeaways there?
Yeah, trade data was unexpectedly disappointing. Exports came in less than half of the median forecast, coming in at 2.4%. The median forecast was 6%. And exports was really that one bright spot for the economy, right? But the fact that it is sputtering out as well, that shows the headwinds that China is facing with the widening trade deficit becoming a source of trade tensions with other countries, prompting more countries to place these trade curbs on China. And imports as well, just inching up by 0.3%, showing that persistent weakness in domestic demand. And when it comes to credit data, it was a bit mixed. It came in above expectations when it comes to the broad number, but that is mainly driven by government debt. Almost all of that growth is because of that huge increase in local government bond issuance, 1.5 trillion yuan of that. But when you look at new yuan loans to consumers and businesses, that is still below what it was last year as well. Again, that reluctance for businesses to expand investments, and also when it comes to mid and long-term borrowing for consumers, which is a proxy for mortgages, that is less than half of what it was last year.
Min, thank you so much. Min Lo, on all the data which came through late on Monday. Right. The big breaking news story, of course, out of China, well, concerning China in the last couple of minutes or so here. So, well, the country has begun enforcing this long overlooked tax on overseas investment gains by the country's ultra-rich. Let's bring in Lulu Chen, our Asia investing editor, to talk us through this. So what exactly are we talking about here?
Well, we've learned that some ultra-wealthy individuals in major Chinese cities have been contacted by the Tax Bureau, and they've informed them to do self-assessments on their overseas investment gains or go for meetings and do such evaluations. This started happening in recent months. It's the first time that these individuals have ever been reached out on such a notice, even though the practice of handing in income based on your worldwide income is a long-standing practice in China.
What's driving this in some ways? Is it part of this whole Common Prosperity campaign too?
I think it underscores the urgency of the Chinese government to expand its avenues of revenue. This comes as China's physical revenue and also tax revenue, land sales are dropping. Also, China began implementing CRS, which is a global reporting standard to prevent tax evasion in 2018. And so now on the data front, it's much more transparent.
So we talk about ultra-rich. Do we know which specific group is affected by this? How is this affecting that group?
It's unclear how widespread this is, whether it's a systematic approach, whether this is the signaling of more of such efforts to be coming, that's unclear. What we know is some individuals that were reached out, they have assets of at least 10 million US dollars parked offshore. Also, some of them were shareholders of US or Hong Kong listed companies.
All right, Lulu, thank you. Our Asia investing editor bringing us that scoop here this morning, Lulu Chen. joining us here in Hong Kong. And we're going to be talking markets with StanChart's Wealth Solutions CIO, Steve Brice, who's going to be joining us here, including the latest outlook on the Fed and his thoughts on China's efforts to boost the economy. We're also counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
Nvidia earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
This data is signaling that the economy may not be slowing as much as desired. While we do not want to overreact to this data or look through it, I view the totality of this data as saying monetary policy should proceed with more caution on the pace of rate cuts than was needed at the September meeting.
Today, monetary policy remains in an overall restricted stance, though just how restrictive is somewhat unclear to me. Ultimately, the path ahead for policy will be driven by the actual economic, inflation, and labor market data.
And that was Federal Reserve Governor Christopher Waller and Minneapolis Fed President Neil Kashkari, of course, talking maybe a bit more cautiously about how quickly the Fed can actually cut after that, starting that easing cycle as well. Let's bring in Steve Brice, Group CIO at Standard Chartered Wealth Solutions. I mean, despite a bit of hawkish talk from these Fed officials, you're still seeing a U.S. market that goes from record to record when it comes to the S&P and the like. What could derail this rally, you think?
Yeah, so obviously valuations are stretched, right? So that's the sort of number one concern. And then we have the election outcome. So I think that's going to be the key thing to watch out for in terms of how markets perform. The fundamental data still looks relatively good. So we're still flipping a little bit between it's good news or bad news. I mean, so that's the question that we are all having a little bit. But I think the election is the next thing to watch out for. Obviously, we're only a few weeks away, so we'll get the outcome of that. But if we get a split Congress and a Republican president, Trump victory, that's our sort of danger scenario. So that's the thing that we really need to watch out for.
Why would that be counterproductive for equity markets? Just what's the broad headline there?
Yeah, so I mean, because you don't get the good stuff and you get the bad stuff, right? So if you get a clean sweep of Republicans, you get tax cuts, you get deregulation, but you also get tariffs and you get increased clampdown on immigration. If you don't get the clean sweep, you get the import tariffs coming in, and you get and clamp down on immigration, which increase costs, increase inflation, and that's much more challenging. But you don't get the tax cuts, so that's really the fear here. That it really slows down the domestic policy agenda, but he can then go full out and look at the international policy agenda. So that's really the concern for markets.
Yeah, you don't have your cake and you can't eat it too, as they say. The other thing that you mentioned just now is valuations, and nothing corrects for frothy valuations in a good earnings season. How do you think we're set up going into this one in the U.S.?
Well, yeah, it's a bit challenging, right? Because obviously, as always, as you head into earnings seasons, people have been paring back what people are looking for from the Q3 earnings. So usually, what happens is the actual earnings releases outperform that. So that's obviously will be a bit of a supporting factor for the market. Personally, what I'm more looking at, rather than just the short-term numbers, is actually looking forward and saying, OK, what's the guidance we're getting? We've seen a lot of the retailers pointing to weakness on the consumer side. Right. So that would be something that I'd certainly be a bit more sensitive to say, OK, you just saw Fed speakers obviously talking about how the resilience of the economy. What if that actually isn't really what we're seeing in the forward guidance from some of the retailers?
Yeah, and we've seen a reversal in this bond market. We saw a pretty great rally in the third quarter, and now this melt up in yields. Why do you think that hasn't impacted the equity market?
Yeah, so I think it really comes down to dollar-yen. So, yeah, usually you'd say there's been a correlation over the last few years between bond yields and tech, for instance, which obviously the US is significantly overweighted to. But what we've seen now is obviously dollar yen came down. That's why we saw a bit of a sell-off, and now dollar yen has stabilized and keeps going up. So really, I think we need to see the yen strengthen for the tech sector to really cool off, or to see something much more significant. So personally, I think we're going to get there. I think we're going to see dollar yen crack at some point, but it's difficult to see exactly what the trigger for that is going to be.
What about a prolonged Fed pause and another melt up, another leg higher in U.S. yields? I mean, can that become a base case, or is that still massively a tail risk at this point in time?
I think if they stand pat, I think that would generally be seen as negative, because I think that would come through as obviously you could look at it again, glass half full or half empty, right? So you've got the macro data saying, okay, the economy is not going into a tailspin or not weakening significantly, but you also likely have the fact that inflation's not coming down as quickly as they would like. Yeah. So it's really what's driving that stability. If inflation continues to come down and they say, actually, we don't need to do anything because the economy is strong, then that's probably good for the stock market, but otherwise, no.
Yeah, I was going to ask you, inflation expectations are going up again. I mean, we take a look at what oil markets, there's a lot of geopolitical risk around that, but should we be worried?
I think you need to keep a very close eye on the Middle East, but oil prices have actually been pretty well behaved so far. And obviously, we've had the sort of story out overnight saying that Israel won't attack the Iranian oil production facilities. If that's true, and that doesn't happen, then oil should remain relatively stable. So we shouldn't be too concerned, but obviously something to watch.
Your views on China now, and how have they changed from your views 2 weeks ago?
Or yesterday, or
yesterday, yes. And how do you think they'll be tomorrow?
Yeah, it's probably more important, right? I think, look, the way I look, I try to step back, right, and say, okay, look, what's been happening to the fundamentals, and has what we've seen dramatically changed those, and has the authorities really changed the way they look at the problem? So clearly this is very significant, what they've done. But I'm not sure it's enough to turn around sentiment on a sustained basis, right? So for Hang Seng, we're looking at 20 to 22.5K sort of range for now, right? The talk around this stimulus at $860 billion, the bonds swap effectively from local bonds to central government bonds. To me, I think it's a good thing to do, don't get me wrong, but I don't think it's a game changer. So I think we really need to see people addressing the inflation side, the economy side, to try and get further stimulus for that to break. I'm sceptical about the authorities in terms of their desire to see debt ramp up again. So the debt to GDP ratio has been going up and up and up before the stimulus efforts that we've seen so far. I don't really think that they want to see that debt ballooning again. So from that perspective, I think it's just managing the downside. This clearly helps in that, but I'm not sure it changes the fundamental picture over the next 3 to 5 years.
Okay. Well, it doesn't sound like you're too convinced at this point. Are you looking at better opportunities outside of China now then, or is China still tactically a good trade? So,
I mean, I guess we don't think it's tactically a good trade now, right? So I think the easy money has certainly been made. Yeah. You could take the view in saying, okay, the authorities haven't come up with the fiscal stimulus and they may still come, right? And if you believe that, then still there's juice in this trade. Okay. But if you take the view that maybe anything will be, fairly limited in scope, then probably we're not going to see new highs from here. So it's obviously very volatile. We could have this interview tomorrow and be very different, right? But that's the way I view it today.
Well, 2 weeks ago, you could make an equally strong argument that the next upside would, the next big move would be 20% up or 20% down. Right now, do you think at least the floor is in?
Yes. I mean, I think the difference, 2 or 3 weeks ago was. One, obviously, everybody is underweight. They're still underweight, right? So that's a potential tailwind, right? We're not saying people have gone from being underweight to overweight or even neutral, right? So globally, people are still underweight Chinese assets. So that's the opportunity. But what we saw also was we saw market diversity collapse. So basically, and that's just it's a quantitative tool that we look at and saying, okay, this trend looks at risk of reversal. So you put those together, and then a pretty sizable stimulus and policy effort, then getting such a sharp rally, in hindsight, I guess, shouldn't be a surprise. You're right when people are looking at it and saying, I mean, it was untradeable, it was uninvestable. Now people are going, okay, but we're still reliant on policy. So I think that's the challenge that we see. You know, the fundamentals need to see this tailwind from policy to kick the economy going again.
Steve, fantastic to see you. Let's do this again next time you're in town. Steve Brice there, Group CIO at Standard Chartered Wealth Solutions. Coming up later this hour, in fact, we'll have more on these Chinese markets in about 10 minutes or so, in fact, with Wang out of Alpine Macro. They've been long Chinese stocks since Feb, so we'll see how they think about where we are currently with this rally and what further deliberate exposure one would want at this point in time. The opening bell under 8 minutes away. This is The China Show. Okay, welcome back. You're watching The China Show, 5 minutes away, give or take, from the opening bell in Hong Kong, and we're looking at declines yet again here. So we did close. We had some weakness, of course, on Monday. It was a different story, which we'll talk about later, in the onshore markets, which eventually recovered into the close of the day. Again, the debate continues, Yvonne, where we are in this rally and what to do with all this information out there.
Yeah, it's day to day, as Steve Brice mentioned, right? It could be different when we talk about things tomorrow or yesterday. But yeah, some interesting comments from those in the U.S. I mean, this is one from Morgan Stanley's Lisa Chalet, urging against buying on this China stock rally. They're saying, look, clearly welcome these efforts, but insufficient to spur a new reflationary cycle, right? They're talking about that $10 trillion number again. They think that's what's required to actually get the economy back on the right track. So that's still 5 times near what near-term projections are right now. So she's saying, look, there are other opportunities. The fact that China is stabilizing, you could look at the rest of the world as a beneficiary.
Yeah, I mean, you know, dollars up, yields are up, the U.S. is back, right? So does that constitute another risk of the Chinese equity rally? Or is that a safer bet, if you will, given how far China's markets have come as a bet on China?
Non-U.S., non-EM, non-China EM, they say.
Samir Samana coming out of Wells Fargo, echoing a somewhat similar tone here, running ahead of reality. And, you know, I think we were talking about this in the midst of that initial melt-up, right? At some point, the rally would run into soft data and soft earnings, right? And that's exactly what happened yesterday with the soft trade numbers and also the inflation numbers which came through. So at what point do you go, this is the exposure I need, and let's wait for the economy to start responding to this?
Yep, they're calling, you know, this is another false dawn, as they say. But yeah, you take advantage of this recent bounce to trim your exposure to EM as well as China, according to Wells Fargo. Some stocks to watch ahead of the open, of course. We're watching that energy story, just given what we heard. Reports of here, Israel won't target Iranian crude. That certainly has given markets a little bit to think of here. And yes, they're following the movement in crude. Energy stocks down. The open is next. This is Bloomberg. Welcome back. You're watching The China Show. We're counting down the open of markets, and right now we are seeing futures are slightly in negative territory. The Hang Seng in the pre-market also opening slightly lower here this morning. There is still that debate of how much longer this rally can go. You have a mixed sort of news to deal with, right? This Caixin report about possibly China raising 6 trillion renminbi when it comes to ultra-long special government bonds over 3 years. You pair that with the fundamentals that still look weak. The headline numbers in credit look good, Dave, but you look under the hood, corporates, households, demand's still looking pretty weak. Yeah, and you're right. And it's also we were talking with Li Daokui yesterday. It's also so markets can't seem to come to an agreement on what the actual number is of stimulus, right? So if you ask people who are more familiar, I guess, with the nuance, this one-off swap with local governments, they think that's a massive deal because that then unlocks stimulus in the form of government spending. Yes. But if you go by sort of traditional economics where you do have a budget deficit, then they're like, okay, where's the big number then? Mm-hmm. But to your point, right, the economics don't seem to be playing ball, and not that we were expecting them to play ball anyway this early on. But
I think one of the other things we track as well is, is the CGB market listening? And a rally in CGB yields, is that pricing in further supply, or is it pricing in further, or the lack of reflationary efforts moving down the line? That's another thing altogether. I guess more on that in a moment as well. The open in Hong Kong, so we're down at the open here, 1.4%. So we are giving up the strength from yesterday. Again, this is a day-to-day thing. We're getting literally analyst notes and strategist notes in our inboxes that are calling for how to trade this over the next couple of days. So this is a evolving story. 10 and 30-year CGBs, please, on your screens. The other big news, of course, coming out of, I think it was Shein.
Yes.
Was this the amount of bonds that they're prepared to issue, special government bonds, of course. The other big story is, of course, in oil markets. You're seeing a pullback of about 3% in Brent, a pullback in Shanghai crude of about 4.4%. So expect that to play out as far as the equity market goes. And also alumina, which continues its massive rally in Shanghai. So prices are already at a record going into today, and we're up a further 1.5% here. So lots of things to talk about here.
Yeah, and certainly, our next guest has been longing for this for some time now. Yeah, Wang, Chief EM and China strategist at Alpine Macro. They've been longing these Chinese stocks since February. So it's been about 8 months. We're finally getting this big rally. Yeah, well, I'm just wondering, is there still value being found in this equity market after this surge in sentiment?
Absolutely. I think if you look at globally, all the stock markets, we basically have 3 tiers in terms of valuation, right? We have the U.S. U.S. is really expensive, trading at forward P beyond 20. Then you have China. Chinese stocks are trading at around 10, 12 forward earnings. And then you have the rest of the world. EM excluding the US, EM excluding China, and EM excluding the US, they are trading at around 15. So these are the 3 tiers. So I think even China catches up to the rest of the world, not catching up to the US. This kind of valuation exceptionalism. If China catches up to the rest of the world level, there's still a lot of multiple expansion to go from here.
Right. Do we need further stimulus, you feel, for us to get that multiple expansion?
Well, I think, first of all, we don't really know what's the stimulus program yet, right? So we don't, they didn't give us a concrete number yet. My view is this. I think this is Beijing's whatever it takes moment. They have an open-ended commitment to boost the economy. So I think these are kind of, more of a qualitative assessment rather than quantitative, because qualitatively, I think this is a major policy U-turn from their policies before. Like before, they were refusing to use massive stimulus. Like they repeatedly said they would never use massive stimulus to boost the economy. Now they are doing that. I think before, I was on this show before, like my view is the reason why the Chinese economy suffered so much was precisely because they didn't offer enough stimulus. So now they are doing the right thing. They're correcting the policy mistakes that they did before. The second one is, I think this is an open-ended commitment. I do not really think they have a number in their mind. I don't really know, like, 6 trillion RMB will be enough or not. I think to them, they will have to be data dependent, right? So nobody knows exactly how much stimulus the country needs. So I think this is an ongoing process.
That's interesting. They don't have a clear, number in mind. What are you telling your clients now? I mean, obviously, we've seen 8 shares have been the key outperformers here. Are we likely to see the A share market catch up to that? What's the strategy now? Are you looking at moving forward?
Well, I think overseas Chinese stocks are probably still more attractive because they are cheaper, and it's easier to find really beaten down names in the overseas market. But I think both the domestic market and overseas markets, I think they will both do fine.
Okay. When do we expect, or when do you think earnings will start to bottom? That's number one. Or if ahead of that, when do you expect corporates to start, responding in the form of, I guess, better guidance, really, to all the news that's come out so far? In other words, the rally needs something to latch onto next if we don't get any big number. And what do you think that will be?
Yeah, I think that's a great point. I think now we are still in this kind of reflex rally, right? So now the market is just responding to this kind of catalyst. So then eventually we need to verify whether the economic performance is beginning to improve because of this, whatever policy stimulus they're gonna do. So yeah, so I think the next stage of the rally will be, we need to see numbers. So I think, like, if you look at forward earnings on the rate of change basis is beginning to accelerate. So I think that's probably, maybe that's some expectation that the earnings will begin to improve. But again, obviously, in the forward earnings, there's expectation built in there. But for now, yeah. So I think all the economic numbers will be pretty bad for Q3, for Q4. I think, otherwise, why Beijing almost feel like in a state of panic, right? So clearly the economic picture is pretty dire. So that's why I don't really think we need to focus on whatever the numbers we are reading like this month. Market will always be pricing for what will the growth situation will be let's say in 6 months. I think that's what as a strategist, that's what we advise clients. So I think in the next 6 months, my view is that growth situation will pick up. This will be a process. But I think if Beijing is really committed to boosting the economy, I think they do have a lot of room to support the economy. I think they need to use the balance sheets of the central bank and the central government to help reflate. I think that's the key.
I look at the 10-year bond yield in China, and we're back to let's call it 2.1%. We're headed back down. When do you think the bond markets in China itself will start responding and reflecting, hopefully, that reflationary scenario that comes maybe after 2 quarters, Wang?
Well, I think it's difficult to say, in terms of timing, but I believe Chinese bonds offer very poor value, right? So I think likely bond yields will begin to pick up. So I think now we have this kind of tug of war. Probably bond market may begin to price in improving growth outlook, but on the other hand, policymakers are trying to push yields down. I think this is the kind of tug of war. I don't think the Chinese policymakers are interested in seeing bond yields to be substantially higher from here. But on the other hand, if the economy improves, so that's why I'm not really, I don't believe Chinese bonds are a good assets to buy from here.
Well, how do I look at November? We're just 20 days away from the election in the U.S. If I'm not going to get a big stimulus number out of China in the next few weeks or so, how much more volatility are we likely to see from this U.S. election if we're actually going to see these tariffs from both sides, the Democrats and Republicans, go through?
Right. Yeah, so I think, first of all, I think as at Alpine, we don't believe Trump will, if Trump gets reelected, we don't believe he will do like 60% tariffs on Chinese goods or 10% tariffs on everything else from the rest of the world. So I think he may likely use these kind of tariffs as a bargaining chip to get some concessions from China. I think that's the first point. The second point is, I think if you look at Chinese growth performance in Trump's first term, in economic performance, and especially the stock market, Chinese stock market did really well. And China actually outperformed the U.S. market between 2017 and 2021. So I think what I'm trying to say is, as a large economy, as China is, domestic policies always matter more. Right, so exports are important, but exports only account for 15% of Chinese GDP. So I don't think they matter that much. So really, domestic demand, domestic confidence, domestic demand, domestic money and credit numbers, I think these are a lot more important numbers for us to monitor. But of course, market can be very volatile, can be very sentimental, so it can be volatile. But at the end of the day, I don't believe tariffs will be the most important thing for Chinese growth performance.
Well, that's why we need people like you to help us sort through the noise. Yan Wang, thank you so much. It was great to speak with you. Let's talk again soon. Yan Wang there, the Chief EM and China Strategist at Alpine Macro. Right, coming up here, more on this Bloomberg scoop that the U.S. may be looking to cap sales of Nvidia and also AMD chip sales to some countries, limiting its rivals' capabilities in artificial intelligence. The details just ahead. This is the China Show. All right, we're looking at further declines and weakness across the oil markets following this. I think it was a Washington Post report, which we'll talk about in a moment here, that Benjamin Netanyahu is effectively looking at military sites in the event, of course, we do get to that point. And yeah, I mean, in some ways, oil markets are reacting to that new piece of information. Of course, Shanghai crude is playing a bit of catch-up right now, 0.5%, well, 5% to the downside, about 14 minutes into the day session in Shanghai. Right, more on this report. So Israel is not planning any strikes on Iranian oil facilities. Let's bring in Derek Wallbank for more. He's with us out of Singapore. Yeah, Derek, what do we know from that report? And how definitive is it, is the other thing?
Yeah, I think let me stress on the definitive side. So the Washington Post reported that Benjamin Netanyahu was willing to, key phrase, willing to strike military targets and maybe not oil and nuclear. Now the Washington Post did reach out for comment to the White House, didn't get a response on that. But when they did reach out to comment from the Israelis, the remark that they got was some version of, we always value what our friends in Washington say, but we'll always make our own decisions. So there is a little bit of gray area there, but it is, sort of unalloyed positive sentiment if you are looking for a contagion risk avoidance. That Israel may be willing to do something that is a more measured response. We talk frequently, right, about whenever there's a flare-up in the Israel-Iran sort of tension situation, how can that be contained? And that real question is something that Joe Biden's administration has been working very, very hard on, trying to get Israel to do less in a response this way. And so the reactions that you're seeing across energy companies, across oil markets, are to the idea that maybe they've been a little bit successful and maybe Israel will not press their case as much as the U.S. and others have feared.
Yeah, what does it tell us about the relationship between Israel and the U.S. now? You mentioned about these two men, that there was some tension before. Does it show at least the U.S. still has some leverage when it comes to the situation?
Well, the U.S. has an incredible amount of leverage when it comes to the Israel situation. I think an underappreciated amount of leverage. But certainly the relationship between Joe Biden and Benjamin Netanyahu is very, very tense. The White House has been very frustrated by the Netanyahu government's moves in a number of different ways of late. It's really hard to sort of uncouple all of this from maybe the frustrations that Democrats are having right now walking up to a coin flip election, right? Like there's a long-standing grumble in the Democratic Party that Benjamin Netanyahu has been way too cozy with Republicans compared to their own party and way too willing to sort of buck and in some cases publicly embarrass Democrats. And so this is a real frustration point in Washington. There's also a bit of a frustration point that the Israel relationship has been used to be something of a very, very bipartisan thing, now has a little bit more of a partisan tilt to it. And so those are sort of long-term trend warning signs. But in the context of an election within the next month, that, as I say, is a coin flip sort of thing, there is risk on all sides, not least of which, let's be clear, from Netanyahu's own government, because in a coin flip election, if, let's say, you wanted Donald Trump, or you thought that you might do better under Donald Trump, well, there's a coin flip chance Kamala Harris wins. So there's a lot to consider on both sides here, right? From the market side as well as from the geopolitical chess pieces kind of analysis.
All right, Derek, thank you. Derek Wellbank there joining us out of Singapore with the latest. Now to another major geopolitical story that we're following for you. Canada and India have expelled each other's most senior envoys as a diplomatic rift erupts again. Canada ordered 6 Indian officials to leave after Canadian police said they had clear and concrete evidence that Indian diplomats were, quote, persons of interest. Now, in the murder last year of that Sikh activist. Now, India later announced that it expelled 6 Canadian diplomats, including the top envoy in New Delhi.
I think it is obvious that the government of India made a fundamental error in thinking that they could engage in supporting criminal activity against Canadians here on Canadian soil, whether it be murders or extortion or other violent acts. It is absolutely unacceptable for any country, any democracy that upholds the rule of law.
And for Bloomberg clients, you can catch up on all the interviews you might have missed here using our interactive TV function, TV Go. We've had some really good ones this hour so far. Bullish in U.S. equities, very bullish in China from 2 separate guests here. So join our shows, and you know how to reach us, of course, for Bloomberg clients via TV Go. Check it out on function, bottom of your screens. This is Bloomberg.
All right.
Yeah.
There's a big interview coming up.
Yeah. Who is it? Stay tuned for this time tomorrow, of course. So it's a person that's in the news, has been in the news, of course, as we move into the U.S. elections. And certainly a lot of what the market is doing right now, and by the way, in case we haven't made it obvious, Donald Trump, we'll be speaking with him as well. Trump trades are back, right? So we have certain measures here that effectively try and model certain equity markets and certain security that would outperform in case, of course, the Republicans win. And we've actually seen that recover somewhat. And I think also separately, a couple of weeks back when Donald Trump was firmly in the lead, according to polls, it was crypto, for example, because it was clear what his attitudes were towards Bitcoin. But also very recently, I think Kamala Harris has also somewhat underscored her views around this broader the broader area. Yeah, so it's not just the crypto story, right? They're talking about financial deregulation stocks, such as regional banks, energy, commodity-related stocks, stocks tied to domestic security. Those actually have been beneficiaries of some of these domestic policies that Trump has highlighted here. But yeah, certainly it's going to be interesting to watch that, right? The steepeners trade is obviously another one to watch as well. But yes, that live interview is going to be happening Tuesday, 12 p.m. New York. So the former president will sit down with our very own editor-in-chief, John Micklethwait, for an exclusive interview exactly 3 weeks from Election Day. You can catch that conversation at the times on your screens. You don't want to miss that one. All right, on to another scoop this morning. Bloomberg has learned that the U.S. may cap sales of AI chips to certain countries, and the move could limit artificial intelligence capabilities in places like the Middle East. For more on our exclusive reporting, let's bring in our tech reporter, Annabelle Jewelers. With what more do we know at this point, Belle?
Well, I think we need to sort of set a little bit of context here. So the Commerce Department in the US, it has a framework called the VEU program, or the Validated End User Program. Now, this is something that allows the US government to track exports of certain high-tech technologies to places like China and India. Last month, that framework was amended to include data centers. Today, our reporting is looking at how the VEU framework could be used to restrict shipments of AI chips to places like the Middle East. So this is a region we know that's looking to invest very heavily into AI data centers in particular. They've got companies that are wanting to establish there or build up their data center presence, and they've also got very deep pockets to fund them. The Middle East, we know it's a place that has a growing relationship with China, which is what these sorts of caps were initially put in place for, was to restrict China's high-tech ambition. So there is a concern that if you allow companies like Nvidia, AMD to export to third-party countries, those chips could still make their way to places, particularly to China.
Okay, and how do specifics like Bell export licenses play into any sort of negotiations here, perhaps as a point of leverage, I guess?
Yeah, they sort of become, I mean, taken literally, but they become a bargaining chip in the whole situation here because US officials can look at them as a way to sort of achieve their diplomatic goals. So, for instance, they can put pressure on companies to reduce their ties or to sever ties with China in order to get these chips. So that is one way that they can be used. The US, of course, doesn't want to risk falling behind either in this sort of scenario because, for instance, if it does export to places really outside of the US, they can grow the AI skills and capabilities of non-US companies, or countries rather, that can then be used to undermine intelligence operations in the States. It is, of course, very unclear how US chip makers like Nvidia in particular, but also AMD and Intel, how they would react to these sorts of restrictions, given we've already seen, for instance, Nvidia being restricted, but then managing to change or tweak its most advanced technology to still allow shipments to go into China of less sophisticated chips as well. But certainly, if the US is going to move forward with these sorts of caps, they will also could be difficult to enforce, and it's certainly as well going to be a big test of US diplomatic relationships.
Belle, great stuff. Annabelle Jewelers there in Sydney for us. Right, very briefly look at markets right now. So things are largely back to normal as far as price, and volumes are actually substantially lower than the previous days. More on the market story in the second hour of the China Show just ahead.
Welcome back to the second hour of the China Show. And yeah, we're seeing these stocks drop here in the onshore market here. There's been heavy volume, though. That certainly is one to watch. But there you go. We're seeing that slide about 0.7% for CSI 300. Hong Kong is also falling in tandem here this morning. It seems like today, Dave, it's really more about the weak eco data that is really weighing on sentiment more. And if still, that lingering question of fiscal stimulus.
Yeah, finally, we have some mental space to focus on the fundamentals.
It's been normalized for us, too, the show. we finally got to take a break from all this volatility.
I mean, the fact that when I was looking at my screens here, my attention went to markets like the Philippines, not for anything else, but certainly there is a focus on other things apart from trying to figure out where the Chinese market is going to be in the next hour or so, right? So I think when you look at Asia, for example, we're doing very well. We're following this typical day what we had on Wall Street. Nvidia's pushing up. More on the Nvidia story in a moment because there's a sort of kink in that story with the Bloomberg scoop. The other big story, of course, is what's happening in oil markets, right? This massive drop we're seeing continued still in Brent and West Texas, and this follow-through we're seeing in Shanghai crude 4.5%. That's playing out as far as the energy counters are concerned in the equity market. Asia energy stocks are also moving against their grain and also on offer. So everything from your big counters in Australia, in S-Oil, for example, in South Korea, changed boards, please, if we can, and some of the other big plays in mainland China, Hong Kong, and also in Japan, for example. So it's almost a broad cross-section of the oil markets reflecting what we're seeing in the equity markets. Do we have our oil? There you go. Thank you so much. We're down about 3%, 2 to 3% as far as that's concerned. Asia, we talked about this. We are tracking the gains on Wall Street. Almost every single sector is trading higher today. You have, of course, a Japanese market that has once again regained the 40,000 level. We're closing in on dollar-yen at 150. And, our guest, Steve Brice, who joined us about this time last hour, pointed out the reason we haven't seen markets react negatively is because the yen has actually weakened, which I think is a good indicator of risk, I think is his view.
He says if we were actually back to seeing that sort of strength in the yen again, maybe we could see that roiling of equity markets here. But we're not seeing that just yet, right? And you take a look at what really is driving that dollar-yen trade. The question today is, are we likely going to find some sort of floor for the yen at this point when we approach 150 levels, which we haven't seen in basically 2 months? And you're starting to see, it's all about what the U.S. rates outlook is going to be in some ways, right? Not so much what the BOJ is going to do. And given the fact that we've seen significant repricing of where swaps are and how far the Fed is really going to cut, it's really gone to one word, modest, right? That, they're really going to, take their time when it comes to when the next cut's going to be.
Yeah, which is a good thing if you look at it from, a glass half full scenario where the U.S. economy is doing well. So there's reset in yields at 4%. Yeah. There's, the dollar index at 10-week highs, and which is why the bull market in the U.S. continues, right? So we're still in that sweet spot where the stance between bad news is good news and good news is good news. In fact, we did hear from several Fed officials overnight. Chris Waller, Fed governor, of course, Minneapolis Fed president Neil Kashkari, also giving their takes on economic policy. Have a look at both.
This data is signaling that the economy may not be slowing as much as desired. While we do not want to overreact to this data or look through it, I view the totality of this data as saying monetary policy should proceed with more caution on the pace of rate cuts than was needed at the September meeting.
Today, monetary policy remains in an overall restricted stance, though just how restrictive is somewhat unclear to me. Ultimately, the path ahead for policy will be driven by the actual economic, inflation, and labor market data.
Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage, joins us right now. Garfield, thank you so much, sir, for putting the phone down. Live TV. There we go. Garfield, is it such a bad thing that the Fed goes into pause mode here?
Well, not at all. I mean, the reason... But that's mostly because, although inflation has shown some resilience, hasn't seriously spiked up. So the reason why the Fed is thinking that, maybe we could pause, or, certainly they're obviously thinking, and market prices reflecting that they might not cut at both of their remaining meetings for 2024. That's because the economy in general is showing plenty of resilience. You've got, the Atlanta Fed's GDP Now forecaster looking for 3% or more growth for the current quarter. You've got the jobs market showing, plenty of strength. Yes, jobs growth has slowed, but it's not fallen off a cliff. The unemployment rate came back down last time around. All of that says to the Fed, yes, it was probably a good idea to cut in September. Probably it was fine to cut by 50 basis points, but it's also, you're also in a situation of very, very much what the Fed desires, where they can take this meeting by meeting, looking at the data, try to fine-tune things in order to achieve, that soft landing that they want, i.e. slowing the economy enough to avoid too much labor market pain without setting off inflation by, cutting rates too early. All that is still on the table. That's what the Fed wants. So, they're pretty happy. They're mostly sounding pretty happy about where they are. Even as some say, maybe we don't need to cut. Others say, yes, but only gradually.
And Garfield, you've been writing about what these Chinese markets are doing. We were joking that, it's been a while since we've seen such a slow news day and not that much volatility in this market. Obviously it seems like we've gone from this big stimulus blitz now to maybe a little bit more drip fee stimulus again, right? We talk about 6 trillion yuan of maybe what they could be raising. I'm just wondering, are we likely just to see a calmer rally ahead? Can we see some more stability in this market?
Well, there's the potential for that, although, the authorities aren't doing themselves any favor. If you think back to, the late September briefing, the head of the PBOC, he outlined some clear, plans for stimulus. There was a bunch of other announcements that came at the same time, which made it obvious that the authorities had woken up to concerns that they might miss their 5% growth target. So that was the template of how you want to do it, not just from the market's point of view. Economists have also been disappointed since then, because that sounded like they'd woken up to the dangers. They had a clear plan. Even if there was some chatter that some of what had gone on was sort of, sudden calls to people who had put in proposals earlier and felt that those proposals had been set aside, and say, actually, hey, you had that idea to help turn around the housing market. Can you run that by me again? That at least sounded like action, even if there was some uncertainty about what the process was that was driving it. But since we've got back from the National Week holidays, there's been a series of events which have produced almost too much information in many ways, but also not enough that's concrete, that's saying, okay, this is what we're going to do, this is what it should achieve, these are the steps that we will take from here. That level of detail has not been apparent, and that's why stocks are struggling to work out where to go.
Garfield, thank you. Garfield Reynolds there, who leads our Markets Live Asia coverage, joining us out of Sydney this morning. And let's head back to Australia, right, where Citi's Australia and New Zealand Investment Conference is underway there. Our co-anchor of Bloomberg's The Asia Trade, Heidi Stroud-Watts, is there on the ground for us. Heidi.
Yeah, Yvonne, here with me is Nathan Sheets, who's the Global Chief Economist at Citi. Nathan, really great to have you with us. And I'm going to take one guess as to what the main question and the main topic that you're being asked today. Should we start with China?
That sounds good to me.
So which camp are you in? Are you in sort of wait and see, this could still be a false dawn, or this is the real deal and they'll get there with their policy objectives?
Our sense is that it's just a matter of time, and that there will be meaningful fiscal stimulus will be forthcoming, and it is likely to be quite helpful for the economy. I don't know if it's going to get us into a world where we again see 5% growth handles for China, but it should, for this year and next, ensure that they're well into the 4% range.
Is that a happy new normal for China? Because we know a lot of the structural slowdown elements had to happen.
Absolutely. I think what you're seeing is just kind of a natural maturation of the Chinese economy. And as levels of per capita GDP rise, rates of growth just naturally slow. The United States grows much more slowly than many emerging market economies. Why? Because it's closer to the technological frontier, and it's all about productivity growth. And you're seeing that maturation in China. So I think 4%, 4.5% growth for China for a while would be a moral victory. And even if you get into a world of 3% handles, that shouldn't be seen as the end of the world necessarily.
Do you worry that there's already an entrenched confidence decline, if not sort of stagflationary, but something akin to that? Is that the biggest risk?
I think that is only a risk. I think it's a reality. And I think that why is the economy as cyclically weak as it has been? Why is the consumer not spending more in China? And I think what's happened is they look out over the medium term and they see high debt levels, they see aging demographics, high youth unemployment, geopolitical pressures, and there's a lot of uncertainty associated with that. And in that world, they don't want to spend today because they're worried about tomorrow. And maybe this stimulus can help boost confidence enough to get the consumer spending again.
How much does the US election complicate that, or do we know, what the unknown is, given that it is President Trump?
I think that the outcome of the U.S. election is likely something that's being watched very closely in China, as it is in many other countries in the world. And I think that if Trump's elected, we are likely to see more tariffs. Now, that said, I should quickly add that the reality is, whether it's Harris or whether it's Trump, that quote-unquote tough-on-China policy that the U.S. has pursued in recent years is likely to continue. And some of those geopolitical headwinds and early signs of global fragmentation that we're seeing that I think are creating headwinds for the Chinese economy, I think we're likely to continue to see that regardless of who wins the U.S. election.
We've been talking about these themes for a number of years now, the bifurcation, the global fragmentation, geopolitical tensions. Do you think that from a trade perspective, from a global markets perspective, that we've sort of learnt to exist profitably in that world?
I think that what's happened is investors have come to understand it and in some sense kind of invest around it. But I really do think in the underlying macro that a fragmented global economy just simply is not going to grow as quickly. It's not going to have the same durability and strength as if we were more integrated. So I do think we're adjusting to it, but it's adjusting to a reality that's subpar relative to where we could be if we had greater integration and less fragmentation.
When it comes to the US, do you think too much fiscal from whoever ends up in the White House risks what the Fed is trying to do and risks that soft or no landing?
When I think about risk to the U.S. economy, I think fiscal and the high levels of debt are very much front and center and probably at the top of my list. And I worry that at some point, investors may say, this is too much debt. Who's going to buy all this debt over the coming decade? So I do think that that is a worry. I like to think, I spent 18 years at the Federal Reserve, that the Fed is going to be independent and the debt levels, the fiscal situation isn't going to constrain it. But the reality is that if we had a fiscal crisis, the Fed would probably have to respond in some way or another. Hopefully we don't see that, but it is on my risk of risks that I worry about, say, over the coming 10 years.
If you were at the Fed now, would you be worried or comfortable with the amount of resilience that continues to surprise from the data points?
I think that Jay Powell has got to be very, very encouraged by the ongoing resilience of the economy, and particularly the resilience of the U.S. consumer. U.S. consumers are inclined to keep spending, and that's very much what we see. Now, part of the reason why the spending has been as resilient is we have seen ongoing significant income growth. And the income growth in the U.S. has exceeded the rate of inflation. And that's been a big support. In addition, balance sheets are very strong. So there's some good fundamentals supporting the consumer. But I think in addition, there's an X factor. And in the U.S., the X factor is consumers like to spend.
When it comes to broadly developed central banks, whether they're coming from, ultra restrictive to ultra stimulative, they're all converging towards neutral. Who do you think should get there first, and who do you think should slow their roll a bit?
I think that the U.S. has outperformed many other DMs, and I think that we're also in a place where inflation is clearly coming down. So I think the case for the Fed to get back to neutral quickly is pretty strong. I think a central bank on the other side of the equation, where they should take their time, is the Bank of Japan. And I think over time they are likely to move back up to a neutral stance. But given that they're trying to achieve 2% inflation on a sustainable basis for the first time in decades, makes a lot of sense to be very, very gradual and cautious.
How much do you worry about energy markets and the broader implications of what's going on in the Middle East? Because again, it feels like we live with an unprecedented level of conflict and war and uncertainty, but we're sort of just coasting through as far as financial markets are concerned.
The key insight, I think, about the Middle East so far as it pertains to financial markets and the economy is that so far there has not been any disruption in physical oil supplies. And I think that the big question as we think about various scenarios that could evolve is what probability do we put on the possibility that there are some barrels that are shut in? Or where shipping of oil becomes more challenging. And I think in that environment, if we did see disruptions in shipping or production and a meaningful further increase in oil prices, that at that point you'd see market and even economic repercussions.
Nathan, really great to have you with us. Thanks for letting us pick your brain. Dave, Yvonne, I'm going to hand it back to you. There was some things to be optimistic about, certainly some things to be worried about there. Nathan Sheets, Global Chief Economist here at the Citi ANZ Conference.
Oh, yeah, absolutely. Otherwise, what would we be talking about 24 hours a day, right? Live TV. We certainly need things to mull over. Heidi Stroud-Watts and Nathan Sheets there, Global Chief Economist at Citi. Right, so we'll continue our live coverage tomorrow there from the Citi ANZ conference taking place where Heidi is, and we'll be speaking with the RB Assistant Governor Sarah Hunter and talking geopolitics with the United States Studies Center.
And coming up on the China Show, here why Bloomberg Economics thinks that China's latest credit data mishighlights and also actually highlights the urgent need for that stimulus delivery. We have analysis coming up next.
Season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
Nvidia earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
Right, welcome back. So a lot of news coming out of China in the last, 12 hours or so. I mean, what's new? So the latest here is, okay, so, you know, the number, the size of this swap program, is this it? I think is the other question. 6 trillion renminbi is what Caixin is reporting that China may raise from issuing ultra-long special government bonds over the next 3 years. That's its efforts, of course, to boost the economy. Now, Bloomberg Economics thinks when you look at some of the numbers which come through, which is a separate piece of news, I should note, underscoring the need, I guess, for more stimulus coming through. And I think from their report is, you look at the data, decent set of numbers, but underneath the hood, there is weakness across the private sector here.
Yeah, let's unpack that with our economist, David Chu. He's with us here right now. So the headline numbers look strong, but you're saying this was mostly driven by government fundraising or funding. Overall, what's your take about corporate sentiment as well as households?
Well, first of all, we need to know that the data covered mainly the period before the stimulus issued by the PBOC, so that gave us a snapshot of what the market was like or what the economy was like before that. Apparently, the confidence was very weak because if you look at the corporate sector and the household sector, they was avoiding raising new debt, so that their borrowing from the financial sector was weaker than the average level over the past 5 years. And especially it was in if you look at the long-term borrowing from by the households, you would see that it was because it was mainly the mortgage. So you will see that was less than half of the previous average, which means the sentiment in the housing market was very weak.
So it's hard to disentangle the two things, right? Because this is a reminder of what the economy still looks like, in fact, right now. What more in terms of monetary support do you think is coming, despite everything else that we've been focused on the fiscal side of things?
Well, first of all, we think there would be some more monetary easing ahead till the end of the year. Governor Pan Gongsheng said that the PBOC can still reduce the RRR by 25 to 50 bips till year end, and we also see 10 bips cut to the policy rate. But the thing is that what can trigger that? I think the government and the central bank will wait and see what the stimulus can do to the real economy, and if they cannot see any improvement concretely in the next couple of months, say until November or the beginning of December, if they cannot see a significant improvement, they will do it again.
Okay. Now, it's the first time we're talking to you following that briefing from the Minister of Finance. What do you make of what was announced?
Well, first of all, on Saturday, the speech or the statement by the Ministry of Finance was some kind of, we don't read it as a stimulus. On the other hand, we read it that the MOF is trying to help to improve the weak link of the economy or the financial system. Because if you look at what they were emphasizing, it was the government debt, it was the housing sector, so that you would see that it's not a simple stimulus, but to help the healthy of the economy. So today we had another news that about the potential debt swap, 6 trillion. Well, for the number, I would say it's not big enough because compared with our LGFV debt, the markets widely believe it could be something around 50 trillion. So 6 trillion is not so much. And we still need to see the arrangement, whether it is to be issued by the central government or local government.
David, thank you, David Chu there, our Bloomberg economist, joining us with the latest. And we'll have more details on this story ahead. We got plenty more to come. This is Bloomberg. All right, we're taking a look at these markets, and yeah, chip stocks are doing quite well here this morning. So obviously what we saw with Nvidia overnight, surging back to that record, certainly is helping the likes of Tokyo Electron up some 5%. Beijing 7 Star also up by about similar measure. There also is that scoop, though, about U.S. Wang capping Nvidia and AMD AI chip sales to some countries. Doesn't seem like that's deterring these bulls to come back when it comes to that whole AI trade. Once again, TSMC also up some 2%. This is Bloomberg. All right, 11:29 a.m. in Tokyo. Japanese markets heading to that lunch break in just a moment. And yeah, we're still watching dollar yen, right? So we're like a whisper away from touching that 150 level here once again. So here we go again as we deal with this weakness in the yen. And certainly it doesn't seem like there's a whole lot of conviction this time that we're going to see initial weakness, which then could lead to a surge back in the currency. But then again, it's helping the equity market stay afloat. Take a look at that. We're at 40,200 for the Nikkei 225 this morning, Dave.
Yeah, Steve Brice reminding us of, we do not want to be in a world where dollar yen goes to 140 immediately, right? Hence, I guess we're at 40,000 here on the Nikkei 225, and Asia is doing very well, 0.6 of 1%. We're back to normal programming in the Chinese markets, and not that much big of price swings, although turnover and volumes are still slightly elevated onshore. We're substantially down, though, as far as Hong Kong goes. Right, CGB market, 2, 5, 10, and 30-year yields on your screens. So the story today is out of Taishin and 6 trillion renminbi likely or possibly for special purpose bonds. And I guess separately, what does it mean for the inflation story, which continues to drop, right? Core inflation in China fell to effectively 0.1% year-on-year based on the latest report.
And most economists you talk to say that's not enough, right? What we're seeing and what we've heard so far is still not enough to bring back this sort of reflationary sort of situation. Let's bring in our next guest and get her take. Vanessa Chan, Fidelity International's head of Asia Fixed Income Investment Directing. Okay, so they're throwing around this number 6 trillion. First of all, I want to get your take on what we've heard in the last few weeks. Is it enough, do you think, to call it the whatever it takes moment for China, or just to set a floor on this economy?
Our broader view is control stabilization. But if you break down in terms of all the policy that come through, you see that it touches a lot of the areas that has been kind of question marks for a lot of investors. So first of all, there's the triple R cuts, that's providing additional liquidity in the market, potentially also equalizing the mortgage rates, which means that there's also release about 150 billion consumption demand per annum. And then the second layer is the capital market, which kind of hopeful to generate a little bit more wealth effect that eventually will probably support consumption. Then there's specific policy that's related to the property sectors, lowering on the down payment, more relaxation in terms of restrictive policies. Then over the weekend, we have the MOF conference call, which provide even more broader kind of intentions and willingness to support the economy via special government bonds. Different names we call special treasury bonds, special local government bonds, ultra long government bonds. All these is really trying to take a little bit more the burden in terms of the fiscal side for the local governments to the central government. And then subsequently, that will also help in terms of bringing a little bit more fiscal health for the local governments as well. So it does touch up on a lot of different parts of the economy where there's a little bit more concern. So we see that as policy to support the economy, to provide more controlled stabilization environment for the longer economic growth.
What I'm wondering is whether we've heard enough to get us beyond the resets, all right? It's been a reset, it's not a recovery, surface level, it's not so much corporates. I mean, you have a background in corporate ratings, for example, and credit ratings, and I wonder, when you see a massive policy U-turn like we've seen, how do you go about figuring out what the individual impact will be across sectors and corporates, for example? And do we have enough information at this point?
Excellent questions. I think now we kind of need to look at two sides of it. One is the high-frequency data. This probably is like the really moment-in-time data that you can get to get an impulse in terms of where the economy is. So I think that's the first thing. Fidelity, we track some of the on-the-ground business activities data as well, just to get a sense of where the economy is. It is, particularly after some of the policy that's been come through. Then the other part of it, which is important, is how the corporates or business are looking at the forecasts, the growth, the capex requirement, and that's also will probably be part of the puzzle that we'll look into to just get a sense of where the economy is heading to as well.
So does it make you want to lean more towards maybe going down the quality spectrum? I mean, do I look more at high yield now, a little bit more attractive, or do you stay around investment grade, safer parts of the market?
Yeah, I think if you take a step back and look at Asia fixed income, given the property crisis that has happened in China and the weaknesses in the Chinese economy, I think Asia fixed income have been battled quite a lot throughout the past couple of years. But if you look at it now, you see that the investment universe is very different compared to what we used to see. So now we have a much more higher quality names within the investment universe. You see that the banks are coming through, and then there is also improvement in terms of some of the frontier sovereign, and then the consumption part of the economy, not just on China, but kind of broader Asian economy is also improving, and which means that the overall quality of these names are a lot higher. If you look at the kind of fallen angel percentage, I think as it peaked, I think back in maybe 1 to 2 years ago, is probably a high single digit. Now we're back to about 3%. And if you look at Asian high yield, I think at some point default rate was teens, and now we're back to 3% as well. So I think the overall credit dynamics have improved in terms of credit quality. Also, if you look at China property per se, historically, if you look at Asian high yield, it's probably more than 20%, and now it's probably less than 5%. So we're looking at a much fresher page when it comes to the Asian fixed income investment universe. And particularly if you look at Asian high yield, the default cycle is over. Overall, you're still getting fairly attractive yield. Duration is relatively short. So we do think that there are some interesting part within the Asia fixed income that investors should be considering.
What's an all-in yield play? What's the best all-in yield play in your view right now?
So if you're looking at Asian high yield, you're probably talking about high single digit at the moment. But then on the other hand, if you kind of want to stay high qualities for Asian investment grade, you'll probably get very attractive duration-adjusted yield compared to your European or U.S. counterpart as well. And I think one of the things we need to be mindful is that a lot of the narratives will be talking about, okay, we kind of moving into a cycle of a rate cut, which potentially could mean a slightly weaker U.S. dollars, where the EM market generally will fare better, where Asian investment grade generally will give you a slightly lower beta contribution as well, which means that it does help to lower a little bit overall volatilities.
Can you tell us, I mean, it's been kind of a whipsaw, right, where we're seeing the equity markets. And when we saw equity surge, people started selling junk bonds. Like
to fund their equity market,
to fund their equity market trades. And then once things started to slide in equities, we started to see people coming back. What do you make of this sort of rotation? What is it telling you?
I think the part of the equity trade is probably a lot to do with the underallocation, I think, for the past 2 to 3 years, a lot of the investors hasn't been looking into China. So I think that's part one. I think part two is for investors to look for opportunities and balancing their risk-adjusted return. Because if you look at bonds, the overall yield is still actually very compelling and very attractive. Spreads may be tight, but if you look at particularly Asia, supply hasn't been very strong actually year to date. It's probably in line with the previous 2 years, which is negative refinancing for the market, which means that there's a very strong technical support that's been provided for the Asia fixed income in general.
And just very briefly, do you think next year that remains the case, that we will not get net new supply in this market?
Yeah, I think we probably need to look at the interest rate dynamics between the local Asian rates versus the US rates. And if you look at what have happened at this juncture, you see that US cut 50 basis point, and you have see some country following 25 basis point and some with 50 basis points. So that could be at least a 25 basis point gap between the US rate and the local rate, which means that they're probably still cheaper to actually do refinancing in the local market. So potentially for the first half, we probably see this kind of same dynamics in terms of supply.
Fantastic. Vanessa, nice to see you. Vanessa Chan there, head of Asian Fixed Income Investment Directing at Fidelity International. Right, looking at cash markets right now, we're looking at modest declines across Hong Kong and mainland China. About an hour into the session, plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show. UK Prime Minister Keir Starmer says that all companies looking to list in London will face scrutiny over workers' rights. He spoke exclusively with Bloomberg after being asked if his government would welcome a listing by Chinese online fashion giant Shein.
Well, I think we've got to get the balance right. And clearly we've got to have standards, high standards. We do have high standards. Not least, for example, in rights at work, and I addressed that in my speech here today to say, look, better rights and protection for people in their workplace are good for growth. So we're clear where we stand on standards, but we're future-looking, we're pragmatic, and subject to those standards, then yes, we do want investment into the United Kingdom because we desperately need growth in this country. We haven't had meaningful growth in the economy in the United Kingdom for 14 long years. We're determined to turn that around.
But just to be clear on that, so the government would need to be sure that Shein's not using forced labour in Xinjiang before it could list in the UK?
Well, I'm not going to get into individual businesses. What I will say, and be very clear about it, standards and high standards do matter to us. So of course we'll be looking at any issue that goes to high standards, with a particular feature on the rights of the workforce. We've been really clear that we see that as two sides of the same coin when it comes to growth. Good employment rights and protections, and a lot of drag on growth. They're fundamental for growth, and I think pretty well all good businesses understand that, which is why in many cases they've already put in place some of the rights and protections that we're bringing forward in legislation.
And that was the UK Prime Minister Keir Starmer there speaking exclusively with Bloomberg's Stephanie Flanders. Some other stories that we're following this morning. The Biden administration is said to be discussing capping sales of advanced AI chips from Nvidia and other U.S. firms on a country-specific basis. Now, sources say the move could set a ceiling on export licenses for certain countries on national security grounds. And we're told that Persian Gulf countries are in focus here because of a growing appetite for AI data centers and the deep pockets needed to fund them. IBM says it's looking into allegations against its China head after a letter circulating online accused the executive of misconduct. Chinese media outlets report that a former employee accuses IBM's Greater China chair, Chen Shudong, of receiving gifts from business partners and leaking company information. IBM has confirmed the existence of the letter and says it takes any allegations of wrongdoing seriously.
Let's get more details on this Bloomberg scoop today. So China has begun enforcing this long overlooked tax on overseas investment gains by the country's ultra-rich. Let's bring in Lulu Chen, our Asia investing editor, to talk us through the details of the story and what we know so far.
Well, some individuals, wealthy individuals in China's major cities have been reached out to by the tax bureau, and they've informed them to do self-assessments on their overseas investment gains, and also either they've been summoned for meetings to do such evaluations. Now, this is the first time these individuals have been reached out to by the tax bureau, and even though China has had a long-standing regulation that residents be taxed based on their worldwide income, they've seldom enforced these practices. So this is a new development since China started implementing the CRS information data system with global banks.
And can you tell us the reasoning behind why we're seeing it now? Why are they all of a sudden enforcing this maybe a bit more seriously than before?
I think it underscores China's government urgency, their urgency to expand their revenue income streams, especially as land sales and also tax revenues have been dropping. The economy is weakening, and also it's in line with Xi Jinping's common prosperity drive, really focusing on China's rich individuals and also balancing out the income distribution.
Do we know enough about how this might affect how investment decisions among the rich? And when we say the rich, who are we talking about exactly here?
Well, we've been told that some of these individuals have at least $10 million parked overseas. Some of them are shareholders of U.S. or Hong Kong listed companies. That seems one of the ways that the tax bureau has been approaching these individuals. There's 3 parts to the taxes that they have to pay: the investment gains on this year, past year, and more worryingly, an interest for overdue tax payments. And that part, if you accumulate all the overdue amount, that can be quite worrying, and which is why individuals who even haven't been reached out are worrying, are concerned about whether they need to take action.
Yeah, I think some people might be calling their private banks as we speak.
All
right, Lulu Chen, thank you, our Asia investing editor, with that scoop. With us still ahead, we're going to hear why German car makers are getting left in the dust by Chinese EV makers in their biggest and most lucrative market. We're going to look at the challenges ahead. This is Bloomberg.
We need to find a deal with China, okay? And we need to get used to a form of co-opetition, or that means basically on the one side you compete, on the other side you cooperate, as actually they did with us when we went 25 years ago in China to take also advantage of the Chinese market.
That was the Renault CEO on how a trade deal is needed with China to ramp up electrification in Europe. But that could face hurdles as well, especially since trade negotiations between the EU and China have been plagued by major disagreements. Let's get to our EV supply chain reporter, Danny Lee. He's with us. Tell us a bit more about these hurdles and where we are in terms of these negotiations now.
We are at deadlock between Brussels and Beijing here, and we are also running out of time before these supposed tariffs come in at the end of the month. And these are tariffs which will rise to as much as 45% on Chinese EV imports. And so there is still huge disagreement between both sides, between Brussels and Beijing here. And we've heard recently that Beijing wants to see car makers collectively negotiate a deal with Brussels. But there are individual car makers who are negotiating because clearly the risk of being potentially blocked out of the EU market is a big one. So everyone's kind of in it for themselves, yet China's trying to think about the bigger picture. So there is still time to talk, but we're very much running out of time here.
The big take today talks about, I think, takes a step back from the story. Underscores certainly the issue at hand is just that, the underlying competitiveness among German car makers. What went wrong?
So, I mean, you just have to look at how Germany has really relied on China as a profit center. And so when you look at Volkswagen, BMW, Mercedes, they've got a lot at stake here, and which is why there is so much concern. I mean, we're talking about 38 billion worth of investment at stake. And so they've just seen sales fall. I mean, we've just seen in the recent third quarter just how bad these German automakers have performed here. We're talking about BMW with sales falling 30%. That's their worst performance in 4 years. We see Porsche as well, down 19%. That's their worst third quarter in a decade. So the bad news and the bad sales numbers is piling up here. And where you see them not being able to really respond to customer demands of high expectations around digital products within the car, to even the specs, the actual hard components being outgunned by these Chinese EV brands. It shows how far they're lagging in terms of the China market.
Is that just a Germany story, you think, or do you think all foreign brands basically in China are facing these sort of headwinds?
This is very much a story that is one for all foreign automakers. I mean, the German automakers are different in as much as they're trying to find a path to stop themselves from collapsing in one of their most important markets here, and given how much they have invested over the years, right? And so this is where the German automakers are trying to find that path forward. But clearly, when they're being outgunned on product, on price, that is the challenge where, are they doing too much or too little too late, really?
Danny, thank you so much. Danny Lee there with today's big take. Okay, subscribers can read about more on that story and how German car makers are really just trying to reset or up their game and catch up with their Chinese rivals. That's on Bloomberg.com. It's also on the terminal. It's also on NI. Big Take is your function there. Now, there's, I guess, no easy pivot from this story to this next one we're about to talk about. We'll give you names, though. Bao Li and Qing Bao.
Yeah, I mean, I'm trying to find a good segue. So, obviously, there's still geopolitical tensions when it comes to cars.
Stage one, okay.
Pandas, though, a little bit more softer, right?
Soft power.
Look how fluffy they are. All right. So
a way back into love, as they say.
After 11 months of being absent, China is now sending 2 giant pandas.
Not this one, though.
From China to Washington. I believe it is.
Is it this one?
That's happening this week, so nearly a year after Chinese authorities took back that previous pair and prompted fears that the National Zoo would never see these animals ever again. Well, yes, Bao Li and Qing Bao, 3-year-old male and female, they left the Sichuan region earlier on Monday. That's what we're hearing. And then, we'll see. So they're going to head back to the U.S. But then again, yes, this is when, you just want to play videos of cute, cuddly pandas and just...
Because why not?
Why not?
Why not?
The show.
There's always a reason to. I hope they don't get tariffed, though, coming back in.
No. But yes, at least there's some signs of a thawing, right? In many ways in the whole U.S.-China relationship. So
we kind of just want to keep playing this video.
Yeah.
I really don't want to talk about alumina, but I guess we'll be forced to, given the news flow out there. Speaking of geopolitics, and here's a segue to commodity markets right now. So the Washington Post is reporting that this conversation between Benjamin Netanyahu and the White House might mean that Israel won't be targeting oil facilities in Iran, which is why we're still seeing this pullback in oil prices, and certainly the story there in Shanghai is this pullback we're seeing in 4.5% on the contract there. The story with alumina is really tight supplies as it pertains to the ore needed for aluminum. So we'll talk about that story more on that. But we are seeing a pullback there following that contract hitting a record. Right. Speaking of oil markets, energy stocks in focus too because of the drop in oil prices globally.
Yep. So they're following what we're seeing, that move lower when it comes to crude. And you're seeing the likes of S-Oil, CNOOC, Costco Energy, all falling some 2% here this morning. So, yes, that certainly is one thing to watch, that geopolitical risk premium being slightly reduced now that there are not as much concerns about the supply issue in Iran. And we're also watching some of these Australian payment stocks in particular as well. So the government plans a surcharge ban. So that's why you're seeing like a Smart Pay down some double digits this morning. And we got a big interview coming up. You don't want to miss this one. With the former president, Donald Trump. We'll be sitting down with our Bloomberg editor-in-chief, John Micklethwait. That's later on, just 3 weeks from Election Day. Expect a wide-ranging interview and conversation at those times on your screens.
Yep. Midnights if you're watching out of this part of the world, roughly speaking. So, yeah, I mean, it's a reminder of how long are we from
20 days.
20 days. until I think I'm taking the day off.
Are you?
Yeah.
Nah.
I'd rather have a
always
watch
fun to
party.
come in on election day.
Anyway, we do have special coverage. I think is the other point there as well. So Yvonne and I maybe get to take a step back here as we look ahead to that. Of course, do not miss this big interview coming up with the former president. At those times on your screens again. Very quickly, back to markets right now. We're back to normal programming as far as Chinese equity markets are concerned. Modest declines. Volumes are somewhat reverting back to the mean alongside valuations.
Yeah, it seems like right now the consensus is maybe that 6 trillion yuan number that they're throwing around when it comes to these ultra bonds may not be enough. We'll have more coming up. This is Bloomberg.